Hi, hey Nancy.
And for a single family as an investment property, so which is in the golf course, in the middle of golf course, so that I'm looking for. And I'm exploring the opportunities, what are the possibilities, how much is going to cost, whether I'm going to build it and sell it, or want to keep that home and put on rent. That is still, but I'm pretty much, this is my new project.
That's awesome. Is this in San Jose?
No, it's not in San Jose.
Okay.
But it is in nearby.
Okay. That's awesome, Tushar. Yeah, I think you and I met for coffee a few months back, long before Corona, huh?
Yes, pre-Corona.
Pre-Corona, right. Thanks for introducing, Tushar. Let's go to Aaron, and until Sandhya joins, we can just have some casual chat. Go ahead, Aaron.
Sure. My name is Aaron Gill. I'm from Pasadena, California. A friend of James here. Known each other for probably a little over a year now.
Awesome.
And I'm interested in commercial real estate. I've had rentals in Indianapolis. Also did some mobile home notes and stuff like that. But we're looking to do our first commercial deal as well.
That's cool. Yeah, thanks for joining us, Aaron.
Of course.
Shubhanga, you want to go introduce yourself before Sandhya can start?
Sure. Hey everyone, I'm Shubhanga, and I am Vivek's friend, and I know him for more than, I don't know, I've lost count, I think 15 years now.
15 years now, yeah.
Yeah. Yeah, so I'm actually new to real estate, and I'm here to learn the basics and start investing in real estate. And yeah, and I'm based out of San Jose. Yeah.
That's awesome. Welcome to the meetup, Shubhanga. Yeah. I know Nancy does not have a microphone, but Seiko, can you hear us?
Yes, I can. Can you?
Oh yeah, we can hear you clearly. Go ahead, Seiko. Why don't you give us a brief introduction, and then we can get with Sandhya's introduction later.
Okay. So my name is Seiko Ishida. I'm pretty new to the real estate investing. I've been, I haven't really purchased anything. I've been spending time to educate myself.
Right.
And I was looking into maybe purchasing some apartment to kind of learn, maybe property management and things like that. Then this happened. So right now I'm kind of hold on,
right.
hold, purchasing anything, kind of watching the market, how that's going to go. And I happened to find this, I think in Facebook or something that thought that I can probably get some updates on how the current market is going, and that's how I got find you guys.
That's great. I mean, thanks for joining us, Seiko. And where are you from?
I'm from Japan originally. I was raised and born and raised in Japan, but I live in Seattle, Washington now.
Oh, nice. Okay. Yeah, Henry's from Seattle.
Hey, fellow Seattleites.
Oh, you're in Seattle too? Oh,
yeah.
good.
Yeah.
Sandhya, can you hear us?
Yes, I can hear you, and got my internet fixed. Basically moved to another room.
No problem,
I have
Sandhya.
a hardwired cable instead of Wi-Fi.
That's okay. We'll do some introductions until. Oh yeah, there you are. Okay, nice
All
to see you
set.
again. Yeah.
Yeah. Sorry about that.
No, that's okay. Totally fine. Sandhya, do you mind if I introduce, if I let another few folks introduce and then
Oh,
we can
yeah.
get started? Maybe a
Of
couple
course.
of minutes.
Yeah.
Hey, Eddie, I know you're from Hong Kong. I've seen you on a couple of webinars, but you're the furthest, buddy. Why don't you go introduce yourself?
Hey guys, yeah, I'm Eddie from Hong Kong. Well, actually, I'm stuck in Macau right now, due to the quarantine situation. So, yeah, I'm an investor. I've been investing in this part of the world for the last 10 years. So I currently own 7 property. During COVID, I sold 2 and bought 1. And then now I'm invested into a multifamily project, 336 units. So yeah, I'm just looking to connect. That's why I got on.
That's awesome.
Oh yeah, I also run a meetup in Hong Kong.
Nice.
Is this the multifamily masters, that chapter that you
Yes,
run there?
MFM. Yes.
Yeah, I've seen you in some of those calls. Yeah, thanks for joining us.
No problem. Thank you.
Yeah. Hey Vish, welcome to the meetup. You want to go ahead and give us a quick introduction?
Yes. How are you guys doing?
Doing amazing, Vish.
Yeah, I used to live in Palo Alto, Mountain View for 7 years.
Nice.
And then I moved to Texas. So basically, I'm an investor in single family homes.
Okay.
And transitioned into multifamily about 6 months back.
Oh,
and I also have a Texas real estate license. And I belong to a mastermind group that is from Dave Lindell.
Okay.
It's called Ari Mentor.
Ari Mentor, yeah.
And I'm a passive investor in 3 different syndications.
Mm-hmm.
I'm looking to syndicate my first deal, and I'm working on 3 different deals. They're all in Texas right
That's
now.
awesome. Yeah. And which cities in Texas, if you don't mind me asking?
Well, it's I'm right in the smack in the middle of the Texas Triangle. That is San Antonio.
Uh-huh.
San Antonio, Austin. San Antonio, Dallas, and Houston. I'm right there, right off I-35. You'll have to go through my city if you're going to Dallas from Austin to San Antonio
Nice.
to. These are the 3 cities which I'm looking at.
Uh-huh.
Along with College Station is one potential, Dallas, Houston, and Austin and San Antonio.
Sure.
And a few other smaller cities, so probably but their population really doesn't justify the investment. So I'm just looking to see how to work around that.
Got it. Yeah. Yeah, thanks for joining us, Vish. And you forgot to mention that you're a fitness enthusiast, man.
Oh, yeah. I love fitness. So for fitness, I can do anytime. I don't need any motivation, no inspiration, nothing required.
Right.
That's more like you get up and brush your teeth. For brushing your teeth, you don't need any motivation. So that's
true.
That's part of me. I need to, if I want to have a good day, I need to have my workout out of my way by 7:38 in the morning. So.
That's awesome. Yeah. And James here just completed a 22-mile hike. So he and you may have a lot of chatting to do about
good
fitness.
job, James. So which trails did you go, James?
Yosemite.
Oh, that's fantastic. Off dome? Did you do the off dome?
Yeah, cables and all.
Oh, that's fantastic. That's awesome. You must be super fit then.
Not really. I just like to go on adventures.
Anyway, I'll before introducing Sandhya, I'll let Henry talk about the Coast-to-Coast meetup. Henry, do you want to do that quickly, and then I can start with Sandhya's introduction?
Yeah, so it's nice to have everyone on, and this is our kind of first face-to-face meetup. We have been doing quite a few webinars, events to share kind of information that we learn about real estate or the economy, just between friends and fellow enthusiasts in real estate world. So we've been started actually right around when COVID started, and at first it was intentional for more of a local meetups, but we have friends that we met in California and Tampa and New York, and we just started to do this coast-to-coast meetup, and kind of grew into what we had. We have had about 11 different meetups, and met a lot of. We have a Facebook group which has now grown to 100 people, or maybe even more. So it's been kind of exciting, and kind of learn from each other's and share the journey together. So yeah, that's kind of what the Coast to Coast meetup is about. And we also have been doing a couple of news webinar series, but now we've kind of more evolved into doing more like selected topics, like things like just investing ideas, picking the right location. For some of the newer members that may not be as familiar with commercial real estate, or doing the multifamily beginning or one-on-one series. So more in the pipeline coming. So just stay tuned for the announcement for future events.
Yeah, thanks, Henry. Yeah, I'll just give a quick introduction to Sandhya. Some of you may know her, but I remember the first time I listened to a podcast. It was back home from work. I was listening to your podcast from Kyle and Lalita. And you shared a lot of insights, and I could relate because you were in tech, and then you did some stock market investing, and then you went full-time into real estate. So for all of you who don't know who Sandhya is, she is a full-time real estate investor based out of Dallas, Texas. She was for a long time in a technical role, and also leadership and management role in Texas Instruments, right?
Yes.
And then she became a full-time stock market investor, and she used a lot of those proceeds to start off her real estate career. And right now she is invested passively and actively in about 3,000 doors.
Mm-hmm. Yeah.
And I think and she also actively manages a couple of properties, if not 3 properties in the Texas market.
Yeah.
Got it. Yeah. So Sandhya, I mean, just introduce yourself to our audience, and add anything more that I might have missed. Welcome again to the meetup.
Thank you so much for having me here, Henry, Vivek. It's such an honor to be here. I appreciate meeting with this nice group of people, like-minded individuals is always fun. I, like Vivek said, I moved to Dallas actually 30 years ago. So this is my home. I've stayed here ever since. I've of course gone on vacations to other places, but Dallas is my home, and it's where most of my investments are, both passive and active. I still do both passive and active investing. When I moved here, I went to school here at SMU, and then got my job at TI, worked there for about 14 years, and then had kids and life. And I was like, okay, one of us has to quit, because both my husband and I had very demanding careers. And I had also, my company was so nice, they paid for me to get my MBA. So I had the knowledge and the confidence to invest in the stock market. I was already doing some of it anyway, just from all our 401ks and all of that. So now I was able to do that full time and easily match my engineering salary. So I had my freedom of time to be home with my kids. And then when President Trump took over, and I'm not saying I love him or I hate him, but I know that he paid 0 taxes. And that's the part that I wanted to copy. And the fact that every rich person I had ever met had something to do with real estate. Those were the big reasons why I wanted to get into real estate. But I was afraid of screening my tenants or getting called in the middle of the night because something went wrong and there was a leak and I got a call at Thanksgiving, you know. So I didn't want any of that. And that's what I thought was single family. I see others who are able to employ property management companies and still run single family, but I was under the impression that I had to self-manage it. So I always stayed away from it. But when a friend told me about multifamily and the possibility of syndicating and learning the business by passive investing, that's when I got interested. And I watched a few podcasts, not too many, and then got involved in passive investing right away with my friend. He introduced me to someone I trusted, or he trusted for a while. And then I went to one of these weekend events, and I figured out that among all the different mentoring programs out there, there were a couple of them that were really focused in Dallas, which is my market. So they had a good reputation with the brokers. They owned a lot of properties in Dallas. So almost always, if you look at a property in the Dallas area that gets listed, there's probably some Sumrock student who's touched it. So Brad Sumrock is my mentor. He's the one I joined. And there's a lot of history on properties that I get to find out because of just having the network and connections. So when you join mentoring programs, I want to say this, it is expensive, but for me, it was sort of like a membership to a country club is how I view it. You immediately get access to all these people who are like-minded in that and have common interests with you. So you have access to a lot of people to learn from, to network with, and ultimately to find your partners. Because once you're within a program, everyone underwrites properties the same way. So you're already aligned in a financial way. So now you just have to see, do I like this person? Can I trust this person? And it's very easy to check, right? So within a small group, it's everyone knows everyone. So it's easy to, once somebody has a bad deal, it's very easy and quick to find out and say, okay, that's not the person you want to partner with, versus this is the person you want to partner with, right? So your reputation in a small world, it becomes a very small, narrow world where everyone knows everyone. So that's one of the things that helped me. So I got into Brad Sumrock's group and I invested passively in many deals and eventually found my partners and syndicated 2 deals with 2 different sets of partners. So we have some people who just arrived. Do you want to have them introduce themselves, Vivek? Or
that's okay. We can do introductions at the end, Sandhya. That's fine.
Okay.
But just a couple of questions on the introduction that you gave. You said you transitioned from a tech career to a full-time stock investor, and then became a passive investor before you became an active syndicator, right? How important was it to become a passive? I mean, what did you learn, or what did you gain by doing a passive investment? Just for people who are getting started right here.
There are numerous benefits to being a passive investor, which is why I still do it even today, although I'm an active investor. The first thing is, you get your textbook knowledge from your podcasts, mentoring programs, videos, etc. But then your passive investment is sort of getting close to an internship. So, hey, Venkat, you want to mute yourself?
Sorry.
How are you?
Oh yeah, I think he's on mute now. Go ahead, Sandhya.
Okay.
Yeah.
So I view this passive investing as one of the best ways to learn and leverage some of other people's expertise, like the Venkats of the world, for example, but without taking on all the risk yourself. So when you passively invest, the biggest homework you have to do is about your sponsorship team, number 1, and then the market. And once you do those 2 things, then there comes to the financial analysis of the deal. But by passively investing in so many different deals, I develop my own checklist of what not to do and what to do. And to always ask for a track record of how their properties have performed in the past. So that's one of the most important things I look for is sponsors who are open about how their properties performed. Like, for example, Venkat, who's in our call now, they always show how their properties have performed by quarter of every property. They show the ones that are doing well, and they show the reds by quarter, and they explain why something is red. And I always look for that. I think that's very important to be honest. Not everything is perfect. It's not all a rosy Facebook perfect picture. So tell me why something went wrong and what you did to overcome that, right? That's very important. Correct. So their track record in that particular market is really important. So the other thing about passive investing is, like I said, it's more like an internship. So you get to kind of observe and learn, but you're not really making all the decisions. So you get that next step towards before you take other people's money. You know what it's like to give up your money to someone or a group and feel that sort of pangs of either worry or trust or whatever it might be. So you get to be on the other side of the equation, so to speak, before you do that yourself. So if you've never ever invested passively and all you've ever done is wanted to do syndications, I get a little skeptical. It's like, I don't feel my pain. And a lot of them take a large acquisition fee up front. So one of the questions I ask is, okay, once this deal closes and you've got your nice acquisition fee, do you still have any skin in the game left?
Oh yeah.
Right? I mean, these large deal, even at 1 or 2% acquisition fee is a huge sum that goes to the sponsors.
Right.
So the question I ask is, how much skin in the game do you still have afterwards? So why are you even in it? Right?
Because you have to have your your goals aligned, right? I mean, there has to be skin in the game from both the general partners and the limited partners. Of course, they have skin in the game. But it seems to me that you're saying, I mean, as a passive investor, you get to see the day-to-day, not the day-to-day operations, but on a month-to-month basis.
Yes.
And you kind of are on the ride in that investment, whereas you're not liable for any loan and everything. It's just your capital at risk at that point.
Right. You get to diversify your portfolio by going into real
Correct.
estate. You get to learn. And now, I have very big sponsors like Venkat on my network. If I ever run into a major problem, I have about 50 different people I can call. So by turns, I'll call them and say, I'm having this problem. Have you seen this before? What do you think of this? Right. Like I was analyzing a property that's not far from a property that Venkat and Ramana own. So what did I do before I spend too much time on it? I'm like, I know this neighborhood, but this property, I have some questions. I had a 15-minute call with Ramana, and that was enough for me to make a decision, So the network is priceless when you deal with more experienced sponsors. So as a passive investor, if you've actually given them your money, they would give you that 10, 15-minute phone call, right?
Absolutely.
But if you haven't given them a dime and every time you keep calling them, okay, you want a monthly call with them, you want a weekly call with them. After a certain point, it's like, okay, I don't have time. So, you do get time with experts in the business when you invest with them passively, and you get to see how all the different experts run their projects, right? So you take what you feel is the best of each, or you take the pieces you like from each of them, and you put it together so you know what to do when you run your own property, right? Or you know what to look for the next time you want to passively invest in a property. You go through that checklist and you keep adding criteria each time based on what you liked about one deal or the other.
Correct. Absolutely. And I mean,
numerous benefits.
Yeah. And you keep becoming better, not just at active investing, also passively investing. You build your checklist as you were suggesting. And you become better at screening these deals, the deals and the teams, so that you're becoming a better passive investor over and over again through experience.
More and more sophisticated passive investor. And, I'm still predominantly a passive investor with the occasional deal under my belt to, be a qualified real estate professional, but I don't want it to take over my life. So I don't want to give it the 70, 80-hour work week that I sometimes had to in my corporate world. Correct. So, if let's say I close on a property, like it's been a year since I bought my first property, those first 60 to 90 days are very, very hectic. So I want to be fully focused only on that property. And so I can't handle 2-3 acquisitions within a 2-month period. There are some others who have systems in place and, processes in place. They are what I call the Walmarts of the world or the Nordstroms of the world. But I'm more like this tiny boutique store that the owner knows the inventory of every little thing in their store. So that's my branding. So you may like it, you may not like it. When I have a deal, it's going to be rare, but when I have it, oh boy, I would have done all the thorough homework that there needs to be on it, because I'm going to tap into my experts as well. I'm not just going to do my analysis and say it meets my numbers. It's more than that. I'm going to look for the history on that property. I'm going to look for, did they have to repair a lot of leaks and all that on about a year ago? So there was a property for which there was a call for offers a few days ago. And at first glance, it's just a 10-minute drive from my house. And it was one of those rare properties which underwrote nicely. I'm like, really? At first glance, I plug in the numbers and it works? What the heck? This can't be right. And sure enough, I start asking around. I find the past owners. I dig deeper. It is a chiller property, et cetera, and I find it had a history of.
I see.
And 3 of the properties listed as comps in that property, I had already looked at them last year because 2 of them were for sale last year. So I already knew, that area, oh my gosh, that's got a drug problem. It's got a, crime issue, which, I could solve by getting a police officer to be one of my tenants as an example. But still, the median household income, that entire neighborhood, all of that was going to be too much of a headache for me.
Sure.
Now, there are people who could handle that, but I'm not one of them. I don't want to turn around a high crime, heavy lifting kind of property. So I have this narrow little criteria for the deals I pick. And in the same way, if someone is investing in a property near downtown Dallas, we all know, like Venkat can chime in, but south of downtown Dallas is an area that's predominantly very low income and high crime.
Got it.
I'm not going to invest in a property there, even if it's an excellent operator.
Sure. So, because the neighborhood does not, it does not fit your investment criteria, so to speak. Right.
So you keep narrowing your criteria based on what deals have done well or what you feel comfortable with. Like I like to drive to a property by day and by night. Do I feel safe there at night? That's another of my little criteria. So I pick properties to invest in that are in the area that I live. So I'm not going to invest in North Carolina. I'm sure it's a phenomenal investment location for a lot of people, but I'm going to stick with Dallas, which I know.
Because you're focused in there, and your expertise and your network is something that you can rely on in that particular market. That makes a lot of sense. Yeah.
And there is no doubt that the deals here are a bit overpriced, which is why I went through properly. I didn't deeply underwrite them, but at first glance, at least about 200 deals I've looked at where maybe 3 or 4 seemed like, okay, the numbers could work.
Got it. Yeah.
Or in some other way, I had to reject it. And it's like, or I was just COVID cautious and didn't agree with their rent bumps for the first year.
Got it.
Right? So,
yeah. Sandhya, shifting gears a little, thanks for adding a lot of insight and context to how passive and active investments pan out. But I have a question about your previous life as a stock investor. What are some of the differences between, for the audience about stock market investing versus real estate investing? Maybe a brief description of what your experience has been.
Sure, I'll do that. And you know what, Vivek, when I run out of time, just raise your hand and say, okay, you're talking too much.
Oh, no. No, I'm sure the audience has a lot of benefits. So please go ahead and share whatever level of detail you're comfortable with. Go ahead, Sandhya.
So on a very general level, right? Stocks are still liquid money. So your liquidity is still fine.
Correct.
Real estate, you probably won't get your capital back for a few years. So better, so definitely have 6 months of living expenses before you go into any kind of real estate investment. Even especially hard money lending might be shorter term and give you better returns, but it's also great high risk. So there's this thing called the Sharpe ratio, right? It's a risk adjusted return on your stocks. So same way, what are the risks you're taking and what are the rewards of it? So like I have a risky portfolio. I have a steady portfolio. Then I have like the college education portfolio kind of stuff, right?
Sure.
So I allocate different amounts to each portfolio. And then if one exceeds the other for any way, periodically I balance it out.
You kind of rebalance it out. Got it.
That's right. You got to do that at least quarterly, right? So some things may go too high. Within stocks, again, there are so many risky ones versus somewhat more stable ones. There are the dividend stocks and there are the high growth stocks. They're the ones that are short-term plays and long-term plays. And within that, there's options and all of that. So I did a little of every one of those. So when I started out, when I was super young, I did more options because I didn't have a lot of cash sitting around, right?
Oh, yeah.
Hard to go buy shares of Amazon and Apple even back then. They were not cheap. So, you go and play options. And then you can do long-term options as well. So options are not just for 30 or 60 days. You can even do 1 year, 2 year calls. It's just they cost more.
Correct.
So I did a lot more options before I had enough of a portfolio to start just buying stocks and buy and hold like a Warren Buffett forever, So I did some of that as well. Ultimately, the reason for coming into real estate, one is to diversify, but also to get the tax benefits. Because the more money I made in stocks, the more we kept bumping into higher tax brackets.
Absolutely.
And I didn't want that to happen. I was like, this is stupid. How come a billionaire bazillion times over is paying 0 taxes? And here I am, a very middle-class engineer person, stay-at-home mom with like 1 income paying this much in taxes. It just doesn't make sense.
Correct.
So I had to do something for taxes. I didn't really want to go start my own business and start expensing every, $5,
coffee or something.
And coffee and things like that. So I wanted something bigger. So when I heard about multifamily and depreciation, I was totally hooked. I was like, okay, this gives me money. I know it's not gone forever, but I get a few years to pay this back later when maybe I can figure out my tax strategy. So that's the biggest thing that got me into real estate, is a combination of tax strategy and to diversify my portfolio. I mean, you could invest in real estate stocks as such to keep more liquidity, but I had to, sort of give this a try.
Got it. I mean, more of rebalancing and also the tax benefits is what drew you into real estate investments. Henry and James, do you guys have any questions for Sandhya or?
Yeah, sure. I'll start to ask a question. Sandhya, so it looks like you're looking at both passive and doing active.
Yes.
Even in today's market, what do you think about, or how do you underwrite deals in today's climate?
First thing I'll do is make sure for the next 12 months, there's not a major rent bump, because it's hard enough just getting collections. So if you're telling me you're going to do these $200 rent bumps or even $100 rent bump just because your property is way underpriced in its rent collection compared to the neighboring properties, I'm going to be like, this is not a certainty. So you cannot have high rent bumps. The second one is assume a higher economic vacancy than what you typically would. So if you look at the T12 of the property, that gives you a true story of how it did during the so-called good times, how it's been doing the last few months of COVID collection times. But a lot of people got their stimulus check, 600, right? And that was a big part of how they were able to pay their rent. So I only had one tenant that I wanted evicted back in April. Today I have 4 tenants I need to evict in the same property who are not paying. Now 4 tenants is okay when it's 86 units, but if it starts getting to be a dozen tenants, okay, now we're getting a little bit worried, right? So I would say that looking at the T12 gives you a pretty good clue of where this property was headed, what their expenses were, and how you think, or the sponsor thinks they can actually cut those expenses. I'd be very surprised if you can cut your expenses and increase rents. So the property basically needs to float, as I call it, or sustain itself, paying all the expenses and everything at a lower economic vacancy than what it is today. That's one thing I look for. Another thing I look for is the location is huge, right? Other than the underwriting, the location itself, is there enough diversity of jobs that are not as COVID influenced or COVID affected, right? So one would think student housing is going to do badly, right? Because everyone's doing things from online. But actually, even though campuses have closed, a lot of students want to stay close to campus. So student housing near campus actually isn't doing that badly in its collections and stuff. But again, I think Neil Bawa has something about that coming up later this week, if student housing is of interest to you. Right. So in terms of underwriting criteria, what else would I look for? I would do what is called a stress test. So what is the lowest occupancy at which you can sustain your property and for how long? And what is the lowest collections at which you can sustain your property and for how long before you have to apply for forbearance, capital call, et cetera, et cetera? What if you did 0 CapEx projects and just did basic maintenance, basic unit turns, et cetera, and that's it? Okay, how realistic is it for you to get close to pro forma rents, and how far are you from that? Because you take whatever the broker gives you in a listing, those pro forma rents ain't gonna happen. And typically when let's say you're looking at a listing today, you're gonna close the property in 60 days. So we're talking what, end of October. Mm-hmm. Okay, that's not the time that's the peak leasing season. So to list the property today, they probably filled it up with a whole bunch of tenants that might be even questionable, just so they fulfill that 90% for your Fannie Freddie loans. Mm-hmm. So you have all these new renewals that just happened, probably at a very low rent, not close to pro forma, that you can't even rent bump for another year. Correct. Right? So that the realistic number has to be factored in rather than what the broker put in your OM. So yeah, there's a lot of little things. Once you start putting in all of that, then the other thing is the reversion cap rate. Is everyone familiar with that term, reversion cap?
Why don't you go over what a reversion cap rate is, just for the audience, so that, yeah.
So the reversion cap is basically the cap rate at which you predict it's going to be when you sell your property. It's your exit cap. So when you sell the property in 4 or 5 years or whenever, according to your business plan, what do you think the cap rate is going to be? Mm-hmm. So to conservatively underwrite, assume a 2-point difference between what you buy it at today versus in 2 years. You could 1.5 difference, but typically, depending on the model you use, a 2-point is super conservative. And that's when, once you put that all in, it's like, okay, no deal actually works. So you have to tweak the numbers somewhere. So who's playing in what cells of the spreadsheet to make the numbers look so amazing that it's like picture perfect kind of look, Correct. Sitting here on the beach in Hawaii and everything is just perfect. There is no storm. There is no volcano. There's nothing, everything is just glorious sandy beaches kind of, presentation you see. So you start throwing the darts and say, okay, what about this? What about this? What about this? And if it still sort of passes the test, then another thing, like I mentioned earlier, is the acquisition fee. A lot of people want an acquisition fee. huge fees because they say they worked so hard to get this property. Sometimes it was off market, so they had to produce all the pictures and marketing material too. Once they collect this lovely acquisition fee, how much skin in the game do the sponsors still have?
Unless they don't have, unless they have an investment.
You put into it, right?
Yeah.
That's an important question to ask.
Absolutely, yeah.
So I would love to hear some of the others chime in with their thoughts on this topic.
Yeah, I mean, if folks want to contribute something, unmute yourself, and you know, we can have a discussion around these topics. That makes it for a whole more fun conversation.
So Sandhya, Tushar here. I have a question. Though I do not have any property in Texas market, but given the Corona situation, and I see going forward, even if it goes away within a year or 2 years, what's a multi-family market is gonna be for B and B plus market? Because what I see in, at least in California market, that people are rushing for single family. There people are vacating those who can afford multifamily, the apartments, high-end apartments. So do you see the similar thing happening in your area or across the country? Just I wanted to know your views.
I don't know about the rest of the country quite as much, but my prediction of Dallas based on living here the last 3 decades, I would say that you'll always have a need for B and B plus because the A's will be too expensive. There will always be a class of people who need that, who like the proximity to a good school or a good neighborhood or their employer, but who can't really afford the A's, A plus, who don't have the credit history to be able to get their own house. Even though houses in Texas aren't that expensive, a lot of immigrant population comes here. They don't have the credit history. A lot of the workforce housing, like I have a pretty big Hispanic population in one of the properties, and they just don't have the credit history. They like to actually come and pay you in cash if they can, right? So people like that, there's always going to be a need for it. And so what the benefit of a B is it offers a lot of the similar amenities, but it's not so new and fancy like an A. So it's people who don't go for the glitz and glamour, but who want the comfort and convenience of that location and who can't afford their own. There'll always be a need for it. There's a lot of people like you know, you look at your current millennials and stuff, they don't want the maintenance hassles of a house. There's still a good group of people. And I know that when I get even older than I already am, I'm looking to downsize, not upsize. I have one kid who just started college now. And my second one, I already have a nice plan in place. So there's no way I want a house of my own. And then if I'm a real estate professional, it makes sense to just rent an apartment so I can, you know, write off the lease numbers in my expenses. So I see a lot of population wanting those apartments.
I mean, generally over the last 10 years, there's been a downtrend in home ownership rates across different age groups. But of late, there's been some reversal. But I think that's also due to the fact that millennials are in the prime buying age right now. Like I think they're turning 31 to 35. So there might be an uptick, but I think overall the trend is just going to continue to stabilize or even go down. That's what nationwide the numbers we're seeing, Tushar. There could be certain pockets where people are flocking to single family homes, but those might be exceptions to the rule is what the data is showing right now.
I think the population growth and the job growth is going to be there in places like Dallas, your Phoenix, Atlanta markets, for example, certainly parts of Texas. So there's always going to be a need for apartments. And a B is just right. It's not horribly bad like a C and D, certain C's and D's, and it's not so fancy like an A that, okay, I might as well just buy my own house. And there's still a good percentage of people who want the convenience of apartments. I just lock the door and I leave. My job is so busy, I have to travel. Or in some other cases, I just don't want to be hassled with all the things that go with home ownership. Or I don't have credit history. So jobs and population growth, there will always be a demand. People are going to leave all those hurricane areas and come to Dallas. I'm telling you, it's going to happen. I did drink the Kool-Aid of Dallas, so you know. That's just the way it goes.
Anyone else have any questions for Sandhya? It's about 5:40. We have about 5-10 more minutes before we begin the breakout sessions.
Vivek, I wanted to ask a question
Go
for
ahead,
Sandhya.
James.
Yeah. We talked about on the sort of the acquisition side of properties, like what you're seeing in COVID, but and because I know, I'm aware that you manage a few properties as well. So in terms of the ongoing process, the day-to-day side of things, what are you seeing with COVID? And it seems like it's very disparate, and it kind of depends on your market, your property, and all these other factors. But as far as your portfolio is concerned, like what is that impact, if any, and kind of any other considerations that you're seeing due to COVID?
So on one property we had, I only had one tenant I wanted to evict a few months ago. Now I have 4 tenants I want to evict because they haven't paid up. But my overall vacancy, economic vacancy number is still within a place where we can afford it. We can still make distributions to our passive investors. It's just we held the distributions. We didn't make one like in May like we were supposed to, but we are planning to do one in September. It's definitely impacted our collections. We have not charged a late fee in almost 6 months now. And we've worked out payment plans with some tenants, and as long as they paid on time, we waived all late charges. So sometimes it's like middle of the month before I even get a payment on some. And so a lot of the other income, as we call it, has been reduced. But in the case of this particular apartment, one of the things we did was we had the leasing office in a unit. So there was a townhouse, 2-story, 2-bedroom, 1.5 bath. That was our leasing office. And we built another leasing office on the other side of our laundry room with strong reinforced walls on it so that somebody could just punch through and get into the cash box and files in the leasing office. So once we completed that construction and moved and had a lot of signage and all that directing people there, we were able to lease this one unit. And that was not really included in our initial pro forma for the first 12 months. So getting that additional rent kind of also helped us overcome some of our collection losses. So we had
it's not all negative changes. There's some positive there as well.
Yeah. And we had already executed most of our business plan, and our CapEx budget, we didn't fully use it. So this office build turned out to be less expensive. We had done fences around our townhouses, and we were able to get the rent bumps for it because the previous owner had, again, like I said, right before they sold it to us, put in a bunch of people with really low rents just to fill up the occupancy. So once their renewals came up, we're already pre-leased at the pro forma rent with new tenants. And hopefully they will pay, right? Fingers crossed. So that's helped. And then we have about 10 or so Section 8 or in some form of government aid tenants, seniors. And so those checks have been coming in all the time. So that's helped a lot.
Interesting.
Another thing we are doing a lot of is retention activities. So we're trying to build a community. So we give a referral fee to our tenants. If they refer someone and they sign a lease and they pay their first month's rent, then the tenant who referred them gets some money back. So we're trying to do the whole community building and community activities so that people stay and then they feel like, oh, I don't want to move because my cousin's here, my best friend's here. We all are, hanging out in this courtyard and et cetera, et cetera. So we're trying to do that. So at least every 2 months, I've been doing some kind of a care package, or we got a truck to come in to do a movie in our big courtyard area, big screen with social distancing, so people could watch a movie in the courtyard. And you're talking $300-400 kind of expense, right. But again, trying to build a community because it's better spent in that than in your unit turns and trying to find new tenants or paying somebody a percentage because they brought them in or giving them half month of free rent, et cetera, right? All the other concessions, incentives you use to get new tenants. So we are trying to step away from that and instead just promote more retention within our community of the good tenants. And of course, we have our list of good tenants and the blacklisted tenants that we want out. So we go through that pretty often.
Yeah, retention is so important, especially now. I think even on the tenant side, they don't want to move into a new unit because it's a new space. It's environment that they're in. It's kind of just another stressor in a way.
Did I answer your question, or did I go off on?
Oh no, that was great. Yeah, thank you. It's just interesting to kind of, because you don't always get to talk to someone who manages assets as well as actually underwrites and looks at them on a daily basis as well. So thank you for shedding light on that.
Sure, and you know what? We have Venkat on the line. He manages about 100 times the number of assets I manage. So if there's anyone you want as an expert witness for this question, that would be Venkat. And I know he's very silent. He's not even showing his face here. But you know what? I'm going to start saying bad things about you, Venkat, if you don't say one.
No.
Venkat's in the
just
Shire.
happening, you know.
So
Oh, I see.
if
Go
we
ahead.
should talk on all this, it should be Venkat.
We do have a.
Yeah.
I'll let Venkat. Go ahead, Venkat.
No, I was just saying that, I share the same concerns that, our Sandhya has laid out, and I have a lot more, like Sandhya said, right? So I got my hand deep into this cookie jar. So I'm feeling more of the brunt of this COVID, and which is hurting some markets, even in a totally different ways than COVID, right? So my biggest issue with right now BNC market in Texas is, yes, I agree with everything Sandhya said. See, we signed up for this, right? So B and C class, we know that these people live, we know that they live paycheck to paycheck. Like 80% of America doesn't have more than $1,000 in their checking account. We know all that, and we signed up to go into B and C, and we were in a great expansion phase over the 10 years, which lasted 10 years, and there was a tremendous momentum up until COVID hit. And our best month was March, even partial. Half of the month is under shutdowns and all that. If I look at collections across my portfolio, we still own about 9 properties, all in DFW, 2,600 units that we are owning today. We sold a few, but we still own 2,600 units in DFW. Our best ever, all the properties set a record, best ever, right? And then it's all downhill there. So it takes a while for us to absorb, but honestly, we thought it's going to be much, 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 much more worse. But thanks to this federal programs, most of the rent got paid. And another thing many people don't like to discuss is the spike in the crime, right? People just sit at home, got nothing to do. You know how they say, right? I mean, the idle mind is workshop of devils or something like that, right? So, and we got these kids running around, sabotaging sewer pipes, putting stones in them.
Oh, wow.
Drug activity, domestic violence, cops being all that. I mean, this craziness is happening across the country, right? And even the middle and upper class society, we see the divorce rate spiking up. I personally, I'm 40 years old, and I never seen anything close to what's going on chaos-wise in my lifetime. What's going on? So it's going to be a troubled time for a while now. And to add to that, in Texas, we are blessed with crappy weather, right? So we get these hurricanes. Right now, there are 2 on our way right now. So that they don't have to come all the way into DFW. If they hit Houston, that's good enough for us because our insurance rates go up.
Right.
Because Texas is considered one market. Taxes, oh my God, don't even get me started there. So we are facing a lot of headwinds here. And I couldn't stress how careful you gotta be, when you're trying to put some property under contract right now or trying to pursue, especially a BNC class 1. On class A, I'm not that much worried. If at all the numbers work, if you can get the equity, which will take 6% to 8% overall return over the 5-year mark. I mean, regular investors won't do that. It has to be semi-institutional or institutional. So I wouldn't worry too much about them, but B and C class, we really have to see where chips fall and wait for the second shoe to drop. Right now, that second shoe didn't drop at all. There might be a second wave of coronavirus. There might be a second wave of shutdowns, right? And, our good old senators and everybody are vacationing right now without a program to extend. Trump did something. I don't know whether people are going to get that money or not. States have to apply and all that. So that has to be resolved, and we don't know when it will be resolved. We don't know what's going to happen in the election. And then this taxes and insurance, like I talked about. And on top of all this, the cherry on the cake is the pricing didn't come down at all. If anything, it's going up because not many people are listing. We were thinking of selling like at least half the portfolio this year. What we stopped short, we're still trying to sell some. We will be selling some. But the supply dried up. So people are just, in the same momentum. Obviously, some people know more than me, right? I mean, they're still paying 4.75, 4.5 cap rates for BNC class neighborhoods and underwriting $200 rent bumps and all that. Obviously, they know more than me.
but the risk to reward ratio that we used to enjoy all these days is no longer there. So we just have to be much more careful. That's what I would say.
Oh yeah, thanks for adding that, Venkat. I mean, there's definitely a lot of caution that needs to be exercised, both from, especially from the active side and more so from the passive side as well. But I think more conservative underwriting, like what Sandhya suggested at the middle of the call, and also the fact that there is some pain to be had, whether that's going to be, we can't put a percentage on that, right? It's going to be what it's going to be.
Yeah, so that's the thing, man. I mean, right now it's so hard to make the deal work if you adhere to your standard conservative underwriting principles, right? It's nothing is impossible, but I'm saying that it's almost impossible to put anything, to pursue anything and win. Let me give an example. Last week there was a deal in Austin. It is built, 2-star property. Okay. We like to expand into Austin, and there was this deal at $106,000 whisper price, and we offered 111. Okay, and we were like kicking ourselves, is like, wow, why do we have to do it? But well, that's Austin, right? It is property very close to domain. We were, stretched on that one, and we were assuming that we will be at least invited into a second round, but we got a call saying that we were nowhere close to it. Then we thought that we misunderstood when that broker said 106. We thought we misheard, and maybe it's a higher number. And broker corrected us that no, you heard it right. It's 106, but we got offers 120 and above for first round. And and they have to underwrite some 25% rent bump in order to justify something like that, because even the broker and seller didn't think it's worth 120 or 125. It's worth 106 is what they thought.
Sure.
But people thought, no, I don't think so. It's worth 125 or 120. And God knows where it will trade up. So it's better to just stay out of these craziness right now. Again, I'm not saying, I don't know for sure that they won't make money. Of course, some people make money, but again, you have to, when you don't know something, you just have to go by the risk reward ratio.
Correct.
If we are right, what we're going to make? What, 6%, 8% a year? But if you're wrong, we lose all of it. So I mean, that's not a favorable risk to reward ratio, and I want to stay out of those.
That's great. Those are great points. Go ahead, Sandhya.
The diversity of deals this year has made people again overpay a lot, because some folks absolutely have to have a deal before the end of the year, but they have a 1031 they have to do, so they don't mind overpaying a little bit, because ultimately, even when they overpay, they'll see the results just a little bit later. So instead of getting their money back in 5 years, it may be 6 or 7 years, but for right now, they've saved themselves so much in taxes or depreciation, right? There must be some other criteria that makes
absolutely
overbid on that property compared to a typical syndication model, right? So I've started looking at smaller properties to see if a JV model would fit better, or somebody who needs a 1031 can tick with me and we can do a deal together, because with the conservative underwriting and having to give passive investors regular returns and reports, it's very hard to make some deals work. So JV ticks, getting creative, or doing financing, being creative in your financing. That's another way to try to make deals work. But I haven't found one yet where I came close to the whisper price to make an offer in the last 3-4 months.
And again, one thing that you have to understand, the part of the craziness is being driven by these interest rates. About a year and a half ago, 10-year treasury was almost 3%, almost, right? And with 200 spread on top of it, interest rates were almost 5%. But now the 10-year treasury took a deep dive, and it's 64 basis points right now, 0.64, right? I mean, which was like never. I mean, it never happened in our lifetimes, right? The people on this call, it never happened in our lifetime, or ever actually, right? Forget about
I don't think it's
our
ever
lifetime,
that low.
Ever, right? So when cap rates usually follow the 10-year treasury, because everything is pegged against 10-year treasury. Even LIBOR, there used to be LIBOR, and people peg some interest rates against that London interbank exchange rate or whatever, and that's being decommissioned right now and being replaced with SOF or something like that. But 99% of the loans peg their interest rates against this 10-year treasury, which is at all-time low. So what happens is, like,
good old days, people used to have these thumb rules, right? So don't pay more cap rate than 3% of over your interest rate. Let's say if your interest rate is 5%, don't pay more than 8% cap rate, or less than 8% cap rate is what people would say. That usually got shrinked right now to 1.5%. So if the 10-year treasury is 0.64, you can get a 2.75, 2.9, or even 3% interest rate. So people are still feeling comfortable paying 4.5. But the issue is, if you remember in 2016 election, as soon as the election happened, the interest rates spiked like there's no tomorrow. Like it spiked more than 1%. If that happens, if we pay 4.5% cap rate right now, and after this election, if the same thing happens, that it won't stay at 0.64 forever, right? For the rest of our lives. So that's, if it spikes, then what happens is, it's going to be a big whiplash, right? I mean, now you paid 4.5. I mean, you literally pray at least that you can get out at a 6 cap rate, because interest rates will spike, and maybe 6 is not better as well. So all I'm saying is, my point is, now if you buy something, we got to be like really, really, really sure about it, meaning that there should be a big margin of error there, a big rent differential between the subject property and the market. And also we should have, damn good management company or managing ourselves, so that we can execute the plan also now more than ever. So that's why, we kind of stayed back on all this, and we're not sitting on our hands. But the good thing is this, look, we always have to find opportunity and during these kind of times, right? So guess who's doing really well when the cap rates are ultra low, interest rates are ultra low? The developers. So if you can develop something and selling at 5 cap rate instead of a 6 cap rate, it's actually good for you. You buy a piece of land, get it entitled, build it, lease it up, and sell it and move it on, right? So our strategy lately, this year, 22, has been focused on construction. Of course, they don't have cash flow, but we feel very safe and sleep much better at night with the construction deals, because the returns will be much, much, much juicier than these B and C class properties with far less risk. And but it's not easy, right? Of course, there is a component where you need to work with really experienced people to pass all these hurdles to build. But we're willing to do that than just getting into willy-nilly into some kind of B class property or a C class property.
Yeah, I think it totally depends on your investment goals and your tolerance for risk. And again, the experience of the sponsorship team. All of those fundamentals apply regardless of the type of investment. Like if you wanted to get into self-storage or mobile home parks or new construction, right? New development. Like you can see Neil Bawa and all the famous people are all having, like David Enko, who's a mutual friend, along with Meryl Caliser, a popular attorney. They're doing a development deal in Austin. And I know like Venkat and Ramana have done a development deal. So I'm invested in a couple of development deals too. But as far as performance goes, it remains to be seen in 3 years, like which one does better. And again, it depends on the economy. But like right now, I'm at least getting some cash from multifamily, but I can't say that that's the best avenue for everyone. If you don't get depreciation benefits or anything, then I think like without depreciation, would multifamily really be better? That's a good question to ask. If it's purely an investment for which, you want to get a good risk adjusted return in a few years, right? So every investor's goals you have to be clear about, and then decide if which is the best investment vehicle for you. Right. Liquidity, depreciation, cash flow, IRR.
I think it's a balancing act, right? I mean, it's all about diversification and risk tolerance.
Yep.
We are at the top of the hour. Thanks a lot for your knowledge, Venkat, and of course, Sandhya. You covered a lot of questions there. We do have one question from Eddie. Eddie, do you want to elaborate on what your question is? If you can unmute yourself. I guess Eddie.
Sorry about that. Yeah,
Go ahead, Eddie.
Actually, it's in the morning for me. So yeah, I got a question for you, right? Since I'm a passive investor, I'm all the way out in Hong Kong, right? So the only thing I could do is being passive. I'm trying to see, is there anything that you guys are preparing for, as a passive investor to look, to get into some of these deals that might be coming up due to, the skinny underwriting that a lot of people have done to get into deals, and these deals is going to fall apart, right? With any of the,
Stressors.
unemployment, unable to pay, right? So some of these deals is going to fall apart, and like investors like you guys, active investors like you guys, could come in and scoop in some of these deals. Is there anything like for you or anybody on the call that's preparing to kind of get ready for these deals? Is there anything that you guys are doing?
Basically have enough cash waiting and ready, right? So that when the right deal comes along, you're ready to pounce. So keep your investor posted, keep in touch with them, the passive investors, right? So that you can define your criteria and tell them as soon as a deal comes that fits this criteria, I'm going to be ready to pounce, that's one thing. And in terms of waiting for deals itself, start networking, right? Like Venkat just mentioned to people in this meetup, he's looking to sell some properties if the price is right. So,
right.
I mean, have that offline conversation as a potential syndicator or deal finder. Like you might be in Hong Kong, but if you establish a rapport with Venkat, he's going to sell his deal and he wants a certain price. See if you can get it off market from him, right? As long as you get the price he wants, you could be the deal finder. Maybe your network in Hong Kong, there's another dozen people who want to invest. You don't have to stay passive. You don't have to say, because I'm in Hong Kong, I have to stay passive, right? I mean, obviously that's a good thing. So in terms of preparing as a future passive investor, again, is it a strong operator? It's a strong market. And if they got it off market, is it a very highly priced, overpriced property, or did they pay a fair price for it? Those would be the questions too.
Absolutely. Thank you so much.
Sure, and I see another question that just popped up in the chat.
Yeah,
what do you think? What is going to happen to the rent rate moving forward?
Yeah, I think Seiko meant rent growth, but I think you touched a little bit upon this, Sandhya, that you are being a little more conservative in terms of how you're underwriting rent growths. Rent growth, I mean, especially given that you cannot increase rents that easily, and also the other income aspect of your P&L has considerably shrunk because there's no late fee, there's more concessions and so on.
Yeah.
But overall, what we've been seeing is some of the markets like Vegas and Orlando, they've been seeing a little bit of a negative rent growth, but we can share more information offline, Seiko.
Great, thank you.
Oh, no problem. Yeah. Yeah, I think now is a good time to go into one of our breakout rooms and have a more intimate conversation with a few folks. So for folks who have not been on breakout rooms before, it's about 4 people to a breakout room, and Henry, James, and I will be shuffling in and out of each of them. So this is a good time to maybe unmute yourself and turn on your cameras so that you can have a face and a voice to talk to. That way, we can say hi, and we'll keep it about 5 to 10 minutes. Henry, is that what we decided? Maybe.
Yeah, we can set. We had 8 minutes before, but we could definitely set it up.
Oh yeah, we can do 8 minutes. That gives us like 2 minutes per person. So 4 people in each breakout room, and we can do 2 breakout rooms, and then a good thing to do is introduce yourself. Where you're from. I think we did a little bit of that at the top of the call, at the starting of the call. But just let people know what you're looking for, and any of the questions, and conversations just flow. So I think that was a good time to go into one of those breakout rooms.
All right, I'm gonna open it up. You guys need a moment.
Raise your hand if you got interrupted mid-sentence.
I think everyone, right?
A newbie operator. Next
I
time,
got kicked out of that place.
Yeah, the 8 minutes or whatever time Henry gave us just fly by.
Yeah.
Well,
Yeah.
Happens.
this is like speed dating. 8 minutes is not enough. So find the right.
My screen said we still had 20 seconds left, and then it booted us.
Yeah, same
I know.
here. Yeah.
Yeah, the first thing I did was get everybody's contact info so that we can have more conversations
smart.
later.
Correct.
That's why you're the guest speaker. You're the smartest one in the room.
Business card thing. I don't know about
Women, we're women, we're natural. Like,
Oh, yeah.
that. Thank you. Be women in the room, and it's like, okay.
Do we want to do one more break? I mean, does everyone have time for another breakout session or? Yeah.
I might just stay for 5 minutes, but yeah. So,
Okay, maybe one more then. Yeah.
All right, Henry's firing her up.
Yeah.
Lot of pressure on Henry.
is
to
it
randomize
random?
things.
Or it'd be funny if we get the same people.
Let me know if you do. Let's see.
All right, off. I think we're in the main room. Yeah, there we go. Took a little bit. And we're back.
Right, you're back.
Lost again in the middle of the sentence, huh?
I think I went on the opposite end where I'm like, okay, we got the first second of warning so that we got to end right now.
Oh, yeah.
But it ended up working out.
Yeah, I know it's close to 6:25. What is the group think? You want to do one more breakout and then call it a night, or do?
I think some people had to drop off.
Yeah.
Yeah, I think we can get everyone's contact info who wants to share it, and then just decide who we want to network with, maybe one-on-ones with different people, and build that connection. I think that'll be good.
Sure. Yeah, we can do that. So folks who want
to share it.
Yeah,
whoever wants to share, there's no compulsion.
Email?
You can just put your email and then name, and then folks who are interested can contact you directly, and then you can start networking offline.
So mine is multifamily, the number 4u@gmail.com. And that's also like my website is multifamily4u.com, where I have a passive investors checklist. If anyone is interested in passive investing.
Sure. Yeah. Thanks, Sandhya.
I love how communicative everybody is.
Yeah. This is the first time you're trying out everyone talking in the breakout rooms. I think it's a lot of value add. I see Srini as well. Hey, thanks for joining, man.
Hi there. Yeah.
Hi. Yeah, one thing, I don't know if you're familiar with Dustin Miles and Hayden Harrington. Those two guys run a really good meetup in the Dallas area. And back when it used to be in-person meetups, you know what they used to do? They have this huge room at this Westin hotel, and all of us would be in different tables. And then about every 10 minutes, like a bell will ring and say, okay, you got to go to the next table. And you have to be moving. You cannot be stationary.
Got it.
You have your drink in your hand, you're munching food, you're having a deep conversation. They'll give you 1 minute warning and stuff, and they'll start walking around making sure you network. They'll chase you.
Nice.
Well, they call momentum real estate, right? That's their brand. So
Keep moving, I think.
Yeah, get the momentum.
I like that.
Keep moving.
I mean, you exchange business cards, you can always continue your conversation,
Sure.
but make sure you meet more people. That's the purpose of a meetup kind of concept. I love that. So a breakout room is basically doing that.
It's basically doing that.
That's equivalent.
Yeah. I like the breakout rooms.
I love that. So I
Yeah.
always try to go in person when they have that.
Nice. And the only person I didn't say hi to is Nika. I'd definitely like to get to know more about you, and we can network offline.
Okay.
I think the breakout rooms didn't put us in the same place. I think Srini as well. But nice to meet you, Nika.
Nice to meet you too. I put my information down in the chat. So save.
Sure. Yeah.
Awesome.
You know how to save the chat? Little buttons down at the bottom.
Sure. I think I'll do that. Yeah. Yeah, I see a folder and then I see all the chat there. Got it.
And you just got to remember where it is in your computer where it saves it. It took me a little while when it first. Where did it save it to? Where did it save it to? Now I know right where they are. So.
Yeah, I think I got the folder there.
If the person who's putting it together, it'll name where you had to save where it came from. You know what that was. So.
Got it. Yeah. Thanks, Nika. Yeah.
You're welcome.
Yeah, I think that concludes our meetup for tonight. Thanks a lot, Sandhya, for adding value to all of our webinar attendees. A lot of great content, the questions, the discussions, and also the breakout rooms. Thanks a lot, everyone, for joining tonight. We'll do again. We'll do this again probably in 2 weeks or a month's time. I know what the cadence is. Henry and James, we can decide more. But thanks a lot for being here tonight.
Thank you.
And also, everybody, if you want to keep up to date on a lot of articles and other postings that we have, and also our announcements for our future webinars and meetups in this case, I just put the link to our Facebook group there. Feel free to join. It's no 20,000 questions to answer to join the group, so it's pretty open. But yeah, we post a lot of great things, and we always encourage this discussion because we're all learning this together. It's the more minds that we can have together, like here, where we can connect with one another, the more that we can all grow together. So thank you, Sandhya, for being such a welcome guest and sharing your insights and knowledge and bringing in your partner in crime, Big Cat. So added a lot of color. So.
Really surprised to see him, and he has offer. He has like 10x the experience I have. You know, so he's definitely a good resource.
Proves the point, right? We're all in it together. Yeah. So, well, that concludes our meetup, everybody. Thank you for being on our first meetup. So.
Thanks so much.
Thanks, guys.
Thank you, guys.
Until next
Have a good night.
Take care, everybody. Stay safe.
Nice meeting you.
Bye.
Bye.